Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Thursday, May 2nd, 2024 edition of Trading Places Live, right here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so. I think I might be able to go the full 30 minutes this morning. We'll see how the voice holds up, but certainly feeling better as the week goes on. Yesterday, the Fed came out, 2 o'clock. No change in the Fed funds rate. I think that's pretty much what everyone was looking for. So that was the consensus, that there would be no change. Not a whole lot differed from prior reports. The Fed, Powell did make one comment that it was much less likely that the next move would be a hike, instead we're still looking at rate cuts down the road. I don't know that that really, I don't know if that caught anyone by surprise. I guess maybe there's some thinking that we're going to have to hike rates again, but I think that's the overwhelming minority that look at it that way. So maybe you can say that we got a little bit of more dovish comments out of the Fed this time, and in the stock market immediately. Well, not immediately. For the first 10 minutes or so, there was almost no change, which is really weird after a Fed announcement. But then things kicked into high gear, and we saw the market make a huge move to the upside, only to turn around in the final hour and basically give it all back. So kept up that record of pretty clear volatility in the final 2 hours after a Fed meeting. That's what we've come to expect. Usually the first move is not the final move, and that was clear again yesterday with that huge spike, followed by the huge decline, basically taking us back to where we were almost unchanged from 2 o'clock to 4 o'clock. So maybe a little disheartening for the bulls for sure, because had some opportunities, I think, the first hour after the Fed meeting to really gain some momentum and perhaps close out this week really strong. We had Apple reporting after the bell tonight. We'll see what happens with that. But, the cards maybe were stacked a little bit in the bulls' favor, and then the carpet got pulled out from under the group as, like I said, we had a very, very weak finish. Good news, though, futures right back up again this morning. I can give you those numbers. Right now, we've got the diamonds, which track the Dow Jones, up 0.6%. The spider tracking the S&P 500, up 0.7%. The QQQ, of course, tracking the NASDAQ 100, many of those large cap tech giants. That's up 0.85%, so between 8 and 0.9%. And then we've got the IWM this morning showing pre-market up 1.23%. So really, really good start to the day so far in the pre-market on the IWM. So anyway, kind of a good hour after the meeting, and then a poor hour, but now it's followed right back with the market trying to take us back up to those highs that we saw yesterday. So maybe some more volatility through the end of the week. I will mention, as I have throughout this week, this is a strong seasonal week for the stock market, the S&P 500 since 1950. The first week of May tends to be very strong through the 5th. Cinco de Mayo this weekend for those who want to celebrate, and the Kentucky Derby. So I got 2 for 1 this weekend. Anyhow, so the first week tends to be pretty good. The 6th through the 25th of May, not so much. And then we go on 26th to the 31st. We typically finish the month in grand fashion from a bullish perspective. So we'll see how it all plays out this month. I think right now I'm still watching those 20-week EMAs. We did have a couple violations last week, but some of them have reversed back to the upside. And we've seen that in history before, where we go down just temporarily, come right back up. So whether or not we can get right back up and clear it and stay there during the next 3 weeks, which historically are not great weeks, that's going to be the challenge. But anyhow, let's take a look at what happened yesterday. We had the Dow Jones Industrial Average. Let me see if I can get this a little bit more readable for everyone out there. So we had the Dow Jones Industrial Average yesterday, finish up 87 points, but you can see that long tail right there showing you that we were probably up about 400 points higher than that with an hour to go left in the market day yesterday. So came back down. We lost a lot of ground that final hour, but now we're right back up again. Pre-market looking pretty good. So we'll just take what the market gives us and let's see how we finish. Let's see if we can clear some key resistance levels, or is this just another head fake before a pullback? Your guess is as good as mine. I do remain very bullish longer term. I just think in the short term, it's a little bit up in the air, and I think you have to be careful, whatever that means to you. You have to be careful when in the short term you start losing key moving averages and you get the death crosses like we've seen here on the Dow, going with the 20-day below the 50. We've seen that across just about all of the major indices. Anyway, Dow yesterday finished up 87. S&P 500 down 17. So clearly a bifurcated market. But like the Dow, you can see we're actually above the 20-day EMA for the fourth day in a row, but we're just not able to close there. We weren't able to close there. We finished on the low of the day yesterday on the S&P, 5,018. Still above the lows that we saw back just a couple of weeks ago in April, but not far. I mean, we only have maybe about 1% of the downside, so it's good to see futures up this morning. NASDAQ 100 down 122 points. So you can kind of see, starting with the Dow to the S&P to the NASDAQ, that the more risk we have, the worse the indices seem to have performed. And that's not necessarily a good thing. NASDAQ also went through its 20-day EMA yesterday afternoon before coming all the way back down, closing near its low. Not a great look, but again, we've got futures up. So are we going to try it again? Are we going to make it this time? We're going to have another failure? That remains to be seen. As far as the NASDAQ 100 goes, though, it may be highly dependent on what happens to Apple at the close today when they report their earnings. Next up, mid caps. Mid caps actually gaining 0.1%, gaining 3 points. But the look of the chart, very similar. Moving up, trying to take out that declining 20-day EMA, failing, coming back down near the low. Russell 2000, ditto. Another one that actually finished up 0.2%. But the IWM was up over 200 with an hour left in the session. It finished at 196.31. That's a big sell-off in the last hour, and to keep us below those moving averages. So, yesterday felt good for about an hour, but we still got work to do, and that's clearly showing up in these charts. Transports, ugliest of all. This is one that's hard to explain away. When I look at the transports, I always think transports don't need to lead the market to the upside. We don't need relative strength, but we want them to go along for the ride, because there's really not too many indices that you can look at that is as closely tied to economic conditions or future economic conditions than the transport group. So when you see the transport group, and the market looks ahead, by the way, it's always looking down the road. It doesn't care about what just happened. Stock market's looking ahead. So when you see a group like this, the transports breaking down to 2024 lows and failing at the 20-day, and even yesterday we saw strength, but nowhere near what we saw in the other major indices. We didn't get close to that 20-day moving average before we reversed and went down and set a new low. So this is, when I consider all the puzzle pieces, one puzzle piece doesn't solve the whole puzzle, but this puzzle piece right here is bearish. There's no sugarcoating it. It's lost multiple support levels. It's trading below the 20-day, which is trading below the 50-day. We've got the PPO, which has rolled over and moved to a new low. Saw almost no strength in the PPO on this last push back to the upside. I would say volume trends are poor. I mean, I got nothing really good to say about transportation stocks, and that is not a great thing when you're trying to evaluate the stock market. You want transports to do well because it's more of an indication of our current economic state and possibly our future, where we're going. And so I think the stock market is telling us something with this, that the Fed needs to be careful in terms of what it's not just saying, but what it does going down the road. And I'm not saying, we want to use this to determine interest rate policy, because obviously you have to consider inflation. And I would say inflation's the bigger obstacle of the two. We want to make sure we keep inflation under control. So I don't completely disagree with what the Fed's doing. I just disagree with their whole back and forth. And their, the Fed's supposed to be transparent. That's what was kind of established under Bernanke many years ago. And I just don't see the transparency. I mean, 1 month to the next, you never know what's going to be said, what's going to be, well, I think we know what's going to be done right now. They're not going to do anything. But anyhow, let's move on to the sectors. So we've got utilities leading yesterday. This is the other thing I like to look at. When you have a new piece of news that hits the market, I like to see, where the money goes. I don't care about what everybody says about what happened yesterday. Where's the money going? And yesterday we had a pretty good day in utilities. Transport's not so much. So that ratio, transports versus utilities, which is one that I like to watch, pretty closely, not as much maybe as some of the others, but it is one that I keep an eye on because I think it gives us a really good idea about the economic strength, either now or maybe 6 to 9 months down the road. And what this ratio is telling me right now is that it doesn't look good. So utilities breaking out again with transports breaking down. Not a good combo. Communication services went up, tested the 20-day EMA, and not too far from the 50-day. We're just getting that death cross there, and we got a failure. So again, that's why I'm interested in these futures being higher. I don't want a gap, what I call a gap in crap. You don't want one of those where you just gap up and then sell off all day long. That's kind of what we saw at the bottom a couple years ago when we kept gapping down and we would rally back. You don't want to have morning strength and afternoon weakness. Just like, the Bears back in 2022 didn't want to see the morning gaps followed by a lot of buying because it was an indication of accumulation. So we want to keep an eye on distribution. We want to continue to look at the market objectively. Again, these are short-term things I'm talking about right now. Look on the weekly chart. Most of our weekly charts still look pretty darn good, pretty healthy. Many still holding above the 20-week moving average. So that's just, again, one piece of the puzzle. But the long-term weekly charts, I do pay a lot of attention to. So if we were to fail, continue to sell off today, maybe have a bad report at Apple, gap down tomorrow, more selling, then yeah, this could morph into something more along the lines of a correction. And again, it's maybe too early to call that. When you see, potential tops, like we talked about really for about 6 weeks from mid-February through the end of March, it hit late. But when you start talking about potential tops in the short term, it's very difficult to pinpoint how bad it will get. And so I just, watch the charts to give me that sign that maybe we're getting into the all clear back to the upside. And until then, I think you just kind of avoid these leveraged ETFs. You can trade them if you want. We got a lot of volatility. You just better get the direction right. I just stay away from that kind of thing. I need to see the market settle back down, get into its groove, start to trend back higher again, see some of these sustainability ratios turn back to the upside in a more meaningful way. Those types of things are what I'll be looking for. Energy, weak again. So crude oil back below $80 a barrel. I didn't look today, but I think yesterday was 79 and change. So we've seen a bigger drop recently in crude oil prices. And as a result, look at what's going on with energy. Energy came back down, closed at 92.03 yesterday, which is now a little bit below that 50-day moving average. So unless we get a bounce from here, energy has quickly given up about 3 months worth of gains. Well, not the whole 3 months, but had a 3-month move to the upside without really a whole lot of selling. And now we've had one move down, a little bit of a bounce, and a second move down. Is this just an ABC correction in a long-term uptrend? Energy bulls, that's what you're hoping for. I see it as something maybe a little bit deeper than that, personally. I didn't know when it would happen, but I did not believe that energy, materials, and so forth were going to continue to lead this market. April tends to be a very strong month for energy. It took advantage, at least during parts of it. And now we're into May, which is not so good for energy. And you can see we're starting to fall back. So maybe we continue to follow that historical pattern. That's what I would expect to see. Media agencies, big day yesterday, breaking out, up 6.18%. I did not look within the group yet to see which individual stock, but I'm sure there's probably one that's really pushing the needle there and lifting the entire group. But I can see that the volume was very heavy on this breakout. So we got one group at least starting to show a lot more strength, both absolute and relative. Next up, next group, water. I don't know what to say. We don't usually talk about water. Water index broke out. I thought it was a meaningful breakout too. It's trending above the 20, which is now crossed above that 50-day moving average. PPO is pointing up, meaning that the bullish momentum is accelerating and we're clearing some important highs. So even though it's a defensive group and even though it's somewhat boring, still wanted to mention it's making a breakout. Personal products, not so good a day for personal products. Very strong support down around 500. We saw that low back in January. We saw it again just a few weeks ago, mid-April. And yesterday, it was like a hot knife through butter. Went right through. Volume was moderate. But that breakdown does not look good on the chart. The AD line also confirming that move to the downside. Appears to be a lot of distribution in that personal products area. So anyway, that's just a quick recap. Let's move on to the 10-year Treasury yield. I can tell you that the initial jobless claims came in this morning better than expected. I believe the claims were 208,000 versus 212,000 expected. We also had productivity and costs, and the unit labor costs, the annual was expected to come in at 3.3%, came in at 4.7%. Apparently, the overall stock market anyway, I don't think really is paying much attention because futures are up, but that 10-year Treasury yield has moved up and is up to 4.65% after closing yesterday at 4.59. So we're in this real tight range right now in the 10-year Treasury yield, and it's going to be interesting to see which way we break because that may be one of the clues as to which way the stock market's going to break. Do we turn this 5 or 6 percentage point decline into something more significant like a correction, a 10% move to the downside? I think a breakout above that 470 level, a definitive breakout, may just kind of push the market over the edge to where we do see a 10% correction. So I'm kind of watching that. And on the flip side, a break back down below the 20-day moving average, which currently is at 4.57, and recent lows are right around 4.57. So if we were to reverse and go back down below that level, then I think you could see the stocks start to turn back to the upside, get back those that are above the 20-week, or excuse me, those that are below the 20-week EMA may find reason to push back up through it. And we could start to resume the secular bull market. So 10-year Treasury yield to me is a fairly good sized piece of the puzzle that I'm continuing to watch right now, as is the volatility index. Let me pull that one up for you because yesterday we had come back down, looked like on that move to the upside, the VIX had set a new low. We were back down below 14.5, which we hadn't been below in about 3-4 weeks. And then we saw the selling into the close. The VIX spiked back up over 15. So what's the VIX going to do from here? It's probably going to depend on what the market does, but we were just up 19.5. If we break back down, look at where we were. We got up to about 19.5. Ignore that open. I never saw the VIX up at 21. I don't know where that came from, but I never saw it go above about 1950 or 1960. Anyhow, that's where we were at the recent S&P 500 low. Now I'm going to move on to the S&P 500 chart and just look back on the S&P like 10 days ago to see where the S&P was then and where we are now. Let's look at that. So here's where we were 10 days ago. Here's where we are now. We're really not that far. Like I said, 1% from the low. And yet we have a VIX that's barely budged back up. During this rolling over of the S&P 500, I would have thought the VIX would be back up to 17.5. Hasn't happened. So now with the market moving back up, if we are able to clear some of these moving averages, you can see how quickly things could resume right back to the bullish side. So I think we're teetering here. I think that if the 10-year Treasury yield breaks out, we start seeing the VIX go back up, I think we could move back down one more time in the market, possibly moving to new lows. But beyond that, I think that's going to would set up a really strong entry into the market. And again, that doesn't exactly line up with history, because we know May 6th to May 25th, not exactly the best time. I mean, it's not huge sell-offs, but I think the annualized return since 1950 of those 3 weeks, or almost 3 weeks, is like minus 12%. I don't know. I sent it out to members in our seasonality report and also in our weekly market report earlier this week. But I kind of remember it being like minus 12% annualized return. So it's worse, obviously, than what the stock market normally does, which is rise on an annual basis 9%. But it's not horrible. I don't want you to think that, because the next 3 weeks, history tells us that, we tend to underperform. That doesn't mean that every year we get a big sell-off. It just means that over time, it's not been one of the better times to be in the market. But there are periods, there are May 5th to May 25th periods, or May 6th to May 25th periods where we go up. There are periods where we go down. But the tendency has been to go slightly lower during that period. All right. So on the S&P, I mean, you can see the rollover. Yes, we're looking to gap up. Maybe we'll gap up 1%. But even if we gap up 1%, that takes us up to about 50, 68, 50, 70, something like that, which is still going to be below the 20-day moving average. It's still going to be below the recent highs. So the gap up is just more noise. The real question is, where do we go from there? And we'll get the answer during the trading day. NASDAQ 100 also rolling over. 1% move here is going to take this up about another 173 points, which would take us back close to 17.5. Well, 17.5, again, still below that, well below the 20-day moving average. So there's still work to be done. The Russell 2000. Now this one's up 1.25%. Let me just get that latest here. It's up 1.16%. It's at 198.59. So 198.59 would be 9 pennies above the 20-day moving average. So this is one that actually could close back up above the 20. I really like this, the IWM, if we get back above that recent high. I'm still seeing, we did have this one red filled candle, but for the most part, we are closing above opens. And I find that to be more bullish than bearish, certainly. And it's doing it, during a period when we're trading below key moving averages, which is a little bit strange. Last time we did this, we did it mostly above the moving averages, but it's just a signal to me that there's maybe a little bit more accumulation. When you're just looking at price action, you don't really see that. But under the surface, I think we're still seeing some accumulation within the IWM. And I think it's just a matter of time. And I can't give you the time exactly, but I think it's just a matter of time before some of the areas that carry small caps, like the biotechs, biotechs tend to love the month of July. We're still a couple months away from that. And then you've got the regional banks out there that need a lift. And they're going to get a lift, I believe, when we get closer to those interest rate cuts. So I think right now we're just going through this temporary period of weakness. I wasn't looking for it, just like I wasn't looking for another leg down back in October. I think it was August to October of 2022. I had already called the bottom, but the Fed wasn't done, with their shenanigans. Don't have another word to describe it. But as a result of what the Fed did back during that period, we saw one more decline, but then after that, it was straight up. I kind of look at the IWM in that same light. Like, it looked like we were going to be getting rate cuts maybe by next month, and now they've pushed it back, and so we've gone back down again. I don't think that changes the long-term picture for me on regional banks. I think we're still in a position where we've got a lot of room to launch to the upside. And if that happens, this is the group this is the index that you want to be paying attention to, the IWM. So I think it's been delayed, but I don't think it's been forgotten. All right, what else do we have? Well, transports, I talked about them earlier. I mean, I got nothing here. From a bullish perspective, I got nothing. Technically, I mean, it is what it is. We're seeing breakdowns. I pay attention to it. I mean, even with this breakdown, no positive divergence. We've already broken to a new low on the PPO. So if I'm on the bearish bandwagon, this is the chart I'm definitely pointing to. But again, the market's made up of a lot of signals. One chart, one signal doesn't dictate the whole picture. And a lot of the other pictures that I have from a longer term perspective still points higher to me. And if that changes, you'll be the first to know. I will announce it on here, but I just don't see that happening. I believe we remain in a secular bull market. And I've been convinced of that through some really rough periods over the last 5 or 6 years. All right, chart of the day. So if you're new to the show, new to Earnings Beats, a couple things. First of all, give us a shot, 30-day free trial. We have a lot of information we provide to our members. We do a tremendous amount of research. We work hard. You're going to learn a lot more about the stock market as a member of Earnings Beats. I can promise you that. Anyhow, 30-day no-cost trial. You do have to provide a credit card so we can get you set up in our system. But I promise you, we will not hit your credit card before responding to let you know that your trial is going to expire. So it's not one of these where we set you up and hope you forget about it. We don't want you as a member if you don't want to be a member. So we will definitely point that out to you. But try us out. If you scroll down, if you just want to learn more about the way we approach the market, best strategy is sign up for our free newsletter, the Earnings Beats Digest, which is delivered Mondays, Wednesdays, and Fridays. Name and email address is all it takes. And we'll talk about all the things that are important to us. I mean, price volume, sentiment, candlesticks, relative strength, earnings, gaps, you name it. It'll be in there. Just constantly reinforcing the things that we like to talk about at Earnings Beats. So anyhow, sign up, name, email address. That's all it takes there. No credit card required. You can unsubscribe at any time. And the other benefit of being on in this community, or I like to refer to it as our EB Digest community, is that anytime we do a free webinar, we will reach out to everyone on our list and provide room instructions. So you can come in, make sure you don't miss any important, valuable information about the market. All right, let's move on. I got one chart here for you before we wrap up. And one of the things I like to do is when we get new news, I mentioned this at the top of the show. When we get new news, and hold on, let me get one final drink before we head into the finale. All right, so one thing that I like to do is when I get new news, I like to see where the money goes after that news is out, because this is new news to everyone. I'm sure that a lot of the institutions already have their minds made up as to what they're expecting from the Fed and so forth. But it's still new information, and the Fed is always saying something new. I'll be nice and just say new. They're always saying something new. And as a result, there's going to be some changes in portfolios and so forth. And the only way you see that is not by watching CNBC, it's by looking at the charts. So what I've done here is I have taken the S&P 500 and I put it on a 5-day chart. And you can clearly see right here what happened from 2 o'clock to 4 o'clock yesterday. When the news came out, you can see this was that first, 10, 15 minutes, maybe even 20 minutes that I was talking about, where the market didn't do much of anything, which is very unusual. Usually at 2 o'clock, we get a big spike one direction or the other. Usually followed, whichever way we go, it's usually followed by another one in the opposite direction. We didn't see that for the first 20 minutes. And I was looking at the market thinking, this is going to be the first time in history that the stock market really didn't do much after a Fed report. Then all of a sudden we took off. I wasn't watching any of the discussion by Powell. So I don't know if this is when he said, I'm assuming it is, but I'm not sure if this is when he said that the next move by the Fed very unlikely would be a rate hike. So he's essentially telling everyone, we're going to cut rates next. It's just a matter of when. And I think that provided some relief to the market that, hey, we're not getting any more rate cuts. And so we took off. But in my mind, it didn't change anything. I mean, I wasn't expecting any rate hikes. I'm sure the majority of market participants were not expecting rate hikes. So I think it wasn't really Fed Chief Powell. It was more Captain Obvious that was speaking. And so that initial move to the upside didn't last. We turned around, we came right back, and look where we finished, almost exactly where we were at 2 o'clock, maybe even slightly lower. So what I did is I pulled up some of the ratios that I like to follow just to see what they did during the 2 hours. And I mean, all of them up and down, up and down, up and down, all of them. Now, down here at the bottom, you can see transports versus utilities basically went down and set a daily low, or at least was right at it. The others did not. And in fact, many of them were, well, some of them were a little bit below where we were at 2 o'clock. QQQ underperformed the spider in the last 2 hours. But others, some of our, the XLY, XLP, and some of the growth ratios actually finished above where we were at 2 o'clock. So there was definitely some rotation. But at the end of the day, I mean, this one was down a little bit. This one's up a little bit. This one maybe down a little bit. This one, it looks like maybe it was just down a little bit, down a little bit. Actually, this one was down the most probably. That's the small cap growth versus small cap value. But essentially, I don't really see anything that was earth shattering. I mean, looking at this, I like the XLY versus XLP outperforming, but many of the other ratios were either at where they were at 2 o'clock or slightly below, similar to what the S&P 500 did. So I really didn't see anything that changed a whole lot yesterday afternoon. But anyway, it's now 9:30. Let's see where we're opening. Didn't really talk about earnings. Etsy reported, though. You can probably look at the S&P 500 top of the board, both in terms of gains and also in losses. And you can see Etsy, Corvo, some of these others that have reported earnings not faring so well. To the upside, though, we had C.H. Robinson perform well. Qualcomm, big name in the semiconductor area, up 7.6%. So that was nice. MGM, gambling, had a nice, I don't know if had a nice report, having a nice reaction, though. Nice action, though, in the market. Lots of green. VIX down, not a whole lot, though. I mean, if the S&P up 0.7%, I would have thought maybe the VIX was back down below 15. So again, this gap up really doesn't do a whole lot for the market. It's simply noise below the 20-day moving average. The first step is going to be clearing 20-day EMAs, and on Friday, holding 20-week EMAs. Those are the two things that I'm looking for really from a big picture standpoint when I look at all the major indices, and we're not there yet. Maybe on the 20-week EMA, we're close or right about there, but on the dailies, we're clearly not there, as I showed you on many charts, trading below that 20-day, failing at the 20-day yesterday, seeing the sell-off from there. Just seemed like a little bit of afternoon manipulation to me. Really, at the end of the day, we had gone nowhere. So let's see if these gains hold, and better yet, can we build on them? From a bullish standpoint, that's what you want to see. You want to see not just a gap up, but we want to see a trend day. A trend day is when you simply just go up in the same direction all day long. It just reeks of accumulation. And obviously, the opposite side would be where you go down all day long, reeking of distribution. But too early to make that call. Let's see where we go. Appreciate everybody, your patience with me this week as I tried to get over this cold. I'm starting to, actually, I haven't felt bad all week. It's just been the voice. But anyway, looking forward to the weekend and relaxing a little bit. I'll try and get those chart lists caught up. I can tell you I'm still way behind. When you fall a week behind in the earnings, in the middle of earnings season, it's not easy catching up. I'm going to be continuing to do that. I'll try and get those chart lists updated this weekend for all the members. Anyway, have a great weekend, everybody. Enjoy the rest of today, tomorrow, and I will see you next show next Tuesday morning right here, Trading Places Live. Happy trading.